Stocks might have fallen a bit today, but the reality is 30% gains in 2013 and continued record highs set by the broader stock market have pushed Americans' retirement savings to record levels. Fidelity Investments, the largest provider of retirement plans, said the average balance in its accounts was $89,300 at the end of last year. For Vanguard, which is another large provider, its accounts averaged $101,650. Those are the highest level, or that's the highest level at Vanguard since 1999 when it began tracking the data. But let's face it, there's good reason to be concerned that the stock market, which is driving up retirement savings, might not continue its historic rise. The Federal Reserve said today that the rates we pay for borrowing, like mortgages and car loans, will stay put for now. But as this economy continues to improve, inflation will rise and so will interest rates. That'll change the rate of return on different assets that are probably in your retirement account. So it's time to pay more attention to how you are generating income. If you think stocks are too risky, there are ways to make sure, we think, that you're at least beating the rate of inflation. Otherwise, you're not making any money at all. Doug Flynn is the co-founder of Flynn Zito Capital Management. He's here to help. He says a little bit of research goes a long way in accumulating long-term savings. Doug, can my viewer, who might be a little afraid of markets generally, or might be very afraid specifically of a market that's run up as much as it's done in the last year and bit, can they make money without exposure to stocks?
Well, you can. It's more difficult on the bond side, and as you get older and you want to protect more, you do need the offsetting of the stock market with some fixed income. And on the bond side, you can, but you have to get away from thinking about both the stock market in terms of S&P and Dow and the bond market in terms of Treasury bonds. You have to get away from just those standard things that we always simplify the stock and bond markets with.
You know, Doug, you and I know that there are a lot of people, in fact, research shows that 36% of workers have saved $1,000 or less for retirement. Now, I don't know, I have to look at those numbers more closely. If you're very young, in your early years, it may not matter as much. But if you have very little money, you're really loath to get involved in the stock market. But you got to beat inflation. So what's the what's the safest thing you can do and get a better rate of return than inflation?
Well, the inflation, CDs are not going to do it. Traditional bonds are not going to do it. Traditional bonds actually, after inflation, especially in a rising rate environment, you'll actually lose money because the interest rate that you're going to get oftentimes will be less than the rate of inflation. So you need to look beyond that. And really, to make this very simple, on the bond side, you want to look at the multi-sector bond category as the area you want to focus in on. And why that's important is because there's actually been 12 times in the last 5 years that interest rates on the 10-year Treasury have gone up. These little pockets of time, about 12 times. In 11 of those 12 times, the total bond market index was negative. However, the category of multi-sector bond was positive in 10 of those 12 times. Why is that? And mainly is because what you're doing is you're turning over the choice of the underlying bond investments to a portfolio manager who has a lot more tools in the toolbox than you might think of just government bonds. They might have corporate bonds, high yield bonds, floating rate loans, all different sorts of things in there, and you're looking for this opportunistic type of fixed income fund that can get you a little bit higher yield. Now, with that comes more risk because it's not so much treasuries, but I might argue when rates go up, if your treasuries are going to lose money, which really has more risk? That's the bond side. All
right, what about, give me some other options. Should people be thinking about dividend yielding stock funds or real estate investment trusts?
They should. Actually, on the stock side, getting away from just thinking about the S&P 500, you can actually drill down. There are ETFs and mutual funds that focus on separating the S&P 500 into different areas. And one of those areas we like are low volatility. We call it low vol. So you can separate into the growth area and the low volatility area. When you're focusing in on the low volatility area of the S&P, you're typically going to get about a 1% pickup in dividend. And when the market turns around negatively, you've got a little bit of a cushion there because these are dividend payers. You also want to look at dividend growers. Those are the types of things that give you a little bit of a cushion, can help you keep pace with inflation, and give you a little bit of upside. So you don't have to have all the same market risk that you would with the general stock market, the S&P 500, because in there are growth stocks that are aggressive. So you can parse that out and look to these alternatives. Real estate investment trusts. What I caution people to do is when you look at these, you can choose in any fund, whether it's a REIT fund or a stock fund, a high-risk one, a moderate-risk one, and a low-risk one. Focus in, especially when the market's higher. You can't really get away from stocks, but what you can do is focus on the ones that have a little bit more downside protection, but at the trade-off, when the market goes up 32, you might only go up 20.
Doug, always a pleasure to talk to you. Thank you so much for giving us some insight into this.
Anytime, Ali.
Doug Flynn is a personal financial manager. He's a co-founder of Flynn Zito Capital Management.